Now you save and you save for retirement to give yourself a good monthly income. That's the goal, right? And then you find out, well, you did a great job. You did such a good job, in fact, that your Medicare premiums go up. Welcome to the 2-year IRMAA rule. Guys, can we talk about what that is exactly and the income thresholds there? And are there any strategies to avoid the Medicare IRMAA trap?
So the IRMAA trap, the income-related Medicare IRMAA trap, it is real. There's a lot of people out there that don't realize exactly what the IRMAA income trap is and how it impacts them until it's too late. What I want to do is I want to take a couple of minutes here and go through what the actual brackets are, the income brackets, and then we'll go through ways that we can hopefully avoid that income penalty. So I have numbers for 2025, and I have projected numbers. Now, keep in mind, these are projected numbers for next year. They're not set in stone. They haven't been approved, but they are projected to go to this. So anybody that earns $212,000 or less as a couple filing joint tax return, or 106 or less, when you sign up for Medicare, your premium is going to be the standard $185 a month premium. Now, this is for 2025, and what they do with IRMAA is they look back 2 years prior. So in 25, they're looking at your 23 income. So naturally, for moving into 2026, they're going to look at your 2024 income. So the brackets are as follows. In 2026, this is projected, 109,000 up to 218,000 will get you the standard Medicare Part B premium. Now, the projected premium is going from 185 to 206.50. Now, there again, I'm not telling you that this is set in stone, but this is the projected increase for Medicare Part B. So the bracket is, if you make $218,001 or above, it goes actually from 218 to 274. Your Medicare Part B premium is 289.10. So you can see that there's a significant increase if you are into that next bracket. That's why it's very, very important to make sure you properly prepare before you take Medicare. You want to start this preparation 2 to 4 years prior, because they look back 2 years. If you are over 274 and $1, it goes up to $413 a month for Medicare Part B. Okay, so these are numbers, these are big numbers. It goes all the way up to $750,000 or more. Your premium is $702.10 per month for Medicare. Now, keep in mind, this is a joint household income. And yes, each one of you, if you are both turning 65, each one of you will be paying the $702.10. Another bracket is 410,000 to 750 is for 660.80, and then 342 to 410 is 536.90. This is the Medicare Part B projected cost for 2026. Okay, so how do we avoid that IRMAA penalty, that income penalty? Well, there's several different ways, and Nolan, I think you and I can kind of tag team on this and go through some of the ways that you can prepare for this beforehand so you may not be penalized.
Yeah, we really want to avoid the Medicare and healthcare income trap, because ultimately it can save you thousands. And, what we talked about, Scott, is the fact of coordinating an overall plan and having all of the key decisions made together makes a big impact. You had gone through a couple different numbers there that can impact what you pay for your Medicare premium. And, the bottom line is $1 over the threshold can be a very costly mistake that can cost you thousands of dollars of healthcare expenses. What you want to do is you want to make sure that you're doing, number one, tax-efficient retirement income planning. And by that, what I mean is that you're looking at what are going to be your income sources kind of in two phases. Number one is if you're going to retire before the age 65, and you're going to get health insurance through the affordable health care, your taxable income matters a lot. I can think of a couple that Scott, you and I, we worked with. They came in, had mentioned they were going to retire at the end of the year, and they were 62. She was 65. He needed health insurance for about 3 years before he could transition over into healthcare.gov. And when we looked at it, what we did is we did the conversion before he retired. And by doing that, what we're able to do is able to keep his income level lower to help bridge that gap to get him some tax credits on what his health insurance need was. And then ultimately when he transitions over to age 65. So the tax efficient withdrawal planning to me really comes down to, what is going to be the impact of some of the bigger life decisions that you make in retirement. Again, I can think of another example of a couple that we worked with. Their desire was wanting to pay off the mortgage. Makes a ton of sense in retirement. The problem was by doing it all in 1 year, it could have not only put them in a higher tax bracket because of the taking money out of retirement account would be considered countable income, it could have doubled what their health insurance premium was. And so if you're considering taking large withdrawals out, it may be better off for things like debt reductions to do that over a 2 or 3 year time frame. Another topic that I oftentimes talk about is the fact that smart retirees are dumping their traditional IRAs, meaning that they're looking to convert money over to potentially tax-free Roth IRAs. And another way to do that is to do that strategically over time and maybe convert a portion of it, considering how it's going to impact things like what your Medicare premium is. Taking those withdrawals that you have from retirement time can be costly.
I don't know if, we talk about Roth conversions and that, but on the flip side, after the conversion is made, what is the benefit to doing a Roth conversion when it comes to healthcare? Well, it's a huge benefit because if you start taking money, bridging that gap, and taking some withdrawals from the Roth, it is not reportable income at that point, which allows you to keep your reportable income lower but still get more money in your pocket by taking some of the money that you've invested into that Roth earlier than 65 or retirement.
Number two is looking at managing your taxable investment income. I talk about a topic called voluntary taxation. So when I look at a tax return, there can be things like capital gains. People should be paying attention to where they're at capital gains wise before the end of the year. How much taxable dividends and interest that you have, making sure that you're doing proper tax loss harvesting. You're managing your different income levels. You're considering, the income that you get from CDs, money market accounts, that taxable interest that you're receiving. There could be more tax efficient ways to keep your investment income lower to help you out. Number three, that goes into using, tax deferred accounts. It may be advantageous if you have some money and you can defer taxes till later, utilizing ways to be able to do that. There's also some other tax advantage accounts that are out there like health savings accounts. The health savings account can allow for those tax-free withdrawals from medical expenses, reducing the reliance that you have on the taxable income. So if you're still working, utilizing those approach. If you have large balances in your life insurance, considering that to be a potential of source of income for retirement. So that comes down to number four, looking at timing and structuring your income, deciding when to draw Social Security benefits, deciding when to do those Roth conversions. Strategies matter, and knowing the difference between taxable, tax deferred, and tax-free income can make a big difference when you put this in place. Now, Scott, these are areas that I think, again, a coordinated effort are things that we kind of walk through and we go through when we're looking at helping people avoid either their health care or their Medicare income trap, because it does make a big difference. It can save thousands.
It can. I want to touch one last thing to remember. If, for example, you were to have a one-off large income year, for example, I had a client that owned some apartment buildings, and he was at a point where he finally decided to retire. He was 68 years old. He said, I want to go off of employer plan, and I want to retire. and quite frankly, I'm not going to manage this apartment complex anymore. He sold the apartment complex, had a very, very large proceeds from that sale, and his income was $85,000 prior year. He had a $500,000 bump that one year, and then the following year it went back down to $85,000. Well, one of the things that we can do and help you with is actually file an appeal. It's kind of like an exception or an appeal, that income was only there because of a life-changing event. Another life-changing event would be when you retire, you're no longer making that income that you were before. You may be living off of some investments and your Social Security and your retirement pension if you had one, and your income could be significantly lower than what it was prior. So that higher income that's causing that IRMAA penalty to kick in, we can file an appeal to say, hey, we've reduced our work hours, we're retired now, our annual income is not going to be what it was. So we can assist you with that. There is a form. It is SSA-44. That's the form that we would need to fill out for you. And basically what that form is going to do is let them know that my income has changed because of a life event, and I no longer are making that money that's throwing me into that IRMAA penalty bracket. So, the big picture with this is the most effective way to avoid IRMAA, the income trap, is to kind of smooth out your income. Be prepared for Medicare and taking that Medicare cost on. Remember, Part B is a monthly premium. Your Part A is free. Your Part B does come with that monthly premium. And if you had higher incomes, you want to make sure that you're preparing for that. And the ways that Nolan went through and the ways that we can help you out is making sure that we're prepared before you sign up for Medicare and get that big bill in the mail.
Well, we know, Scott, that with Medicare season coming right up, it's going to be the big time of the year where a lot of these people are going to be faced with commercials telling them to change and make a decision about changing. Again, I think one of the things that's great about America's Medicare Associates is we're local, we're independent, and we're experienced. So you don't want to have one of those ads or one of those commercials kind of steer you in the wrong direction. Don't just use today's segment to make a decision about your Medicare cost and or decision on what you want to have. Know how it applies to your situation to figure out, what could be the best plan for you going forward.